Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. Silver's epic mean reversion. I found a very bullish article on silver talking about $50 silver that we could be seeing. So if you think silver is bullish, if you think silver is going to reach higher, smash that like button. Let me know. Let's see if this video can get 200 likes. Everyone go hit the like button right now. It's the best way to support the channel, and just share your love for precious metals, as you know I do. So anyways, let's jump into this article. By the way, the link will be in the description if you want to check it out yourself, because yes, we're in for a lot. So silver is due for an epic mean reversion higher relative to gold coming in the coming years. The stock panic obliterated silver prices to their lowest levels ever seen compared to gold. Historically similar but milder silver low extremes were soon followed by massive mean reversion outshoot bulls. After the last stock panic in late 2008, silver more than quintupled over the next couple years, talking about $50 silver starting from 2008 credit crisis. Silver's new bull market upside potential after this latest stock panic looks considerably bigger. Investment capital inflows have already been strong and relentless in this panic's wake. Silver should amplify gold's own bull. So silver is powering higher in the new bull market after getting clobbered in March's stock panic. Investors have been flocking back to silver in the aftermath of the ultra-rare extreme fear event. The brutal sell-off also utterly wiped out speculators' upside bets in silver futures, giving them massive room to buy back in. After being pummeled to record low levels relative to gold, an epic silver mean reversion higher is underway. So are we in the bull market of silver right now? Have we hit the bottom, and are we going to see tops coming soon? That's what this is talking about in that ultra rare event they're talking about, which is the pandemic, threw things way out of left field. So a couple weeks ago, I wrote a popular essay called Big Silver Bull Running. It explained what happened to silver in the recent virus pandemic or panic, and why silver soared in its wake. Sucked into the blinding fear maelstrom, silver was thrashed to a miserable 10.9-year low, 11-year low. This metal plummeted in a near crash fueled by speculators' fastest long purge ever witnessed that exhausted their selling, totally resetting longs. That meant these super leveraged traders' capital firepower was fully available to buy back in silver, and much more bullish than that, strong and relentless silver investment demand emerged since the mid-March's collapse. That's evident that the soaring silver bullion holdings of silver's leading exchange-traded funds, the iShares Silver Trust SLV, to this dominant silver ETF and the best daily proxy for global investment demand. The remarkable capital inflow pouring into silver through that major SLV conduit from the American stock investors were explored in depth in that recent essay. But with surging investment demand as evident in SLV's holdings, its primary thesis, I only had room to tangibly touch another very important bullish silver factor. That's silver's relationship to its overwhelmingly dominant primary driver, gold price trends. This white metal has always tended to mirror and amplify whatever is happening in the yellow one. Let's pause right there. Silver is more volatile than gold. If gold jumps up 10%, silver is going to jump up 15%. If gold drops 13%, silver is going to drop 18%. It just hits more extremes. It hits higher highs and lower lows. So it does whatever gold does, just to a more extreme level. Silver effectively acts like a gold sentiment gauge. Traders' enthusiasm for silver mounts when gold is rallying on balance, leading them to bid higher, well outperforming gold. Since the world silver market is tiny compared to gold's, worth just a small fraction in any given span, capital inflows fuel outsized silver gains. So since silver is a smaller market, even, not even whales, small money can move prices higher or lower, especially when they sell. But when gold is generally drifting lower or grinding sideways long enough to shift sentiment to bearish, silver is abandoned. Speculators and investors alike are only interested in silver when they expect gold to continually materially advance. And with silver joined at the hip with gold psychologically, it tends to leverage significant gold moves by 2-3 times. And where silver trades relative to gold is analogous to its evaluation. The best time to buy silver is when it's abnormally inexpensive compared to prevailing gold levels. That can be measured through a simple construct called the silver-gold ratio. But dividing the silver price by gold, but the gold prices yields a tiny hard to parse decimal like 0.0089 this week. So I'd rather use an inverted axis gold-silver ratio instead, which yields the same data, much easier to understand, which is 112 to 1. The recent stocks panic's extraordinary extreme impact on silver is really illuminated by the SGR proxy. This chart shows how silver has fared relative to gold in the last decade and a half or so. When the GSR line is rising, silver is outperforming gold. The opposite is true when the SGR falls. Gold surpasses silver. The chart is jaw-dropping, revealing exceedingly anomalous SGR levels, which are wildly bullish for silver. So, when silver plummeted to that extreme 11-year low, secular low of $11.96 on March 18th, which wasn't even that long ago, during the stock panic, the SGR soared to 124 to 1. I like to call it the GSR. It's a gold-silver ratio. He's saying the silver-gold ratio, but it's the gold-silver ratio. It was 124 to 1. In other words, it took 124 ounces to equal 1 ounce of gold. And that's crazy because historically the ratio is around 75 to 1. So that's the highest we've ever seen it in 5,000 years. The radical collapse literally forced the GSR off the charts. For a long century, about 100 was the ultra-rare gold-to-silver ratio edge case limit. Now all that term GSRs have been withdrawn. So our daily silver and gold data extends back to June 1969, an immensely long 50.9-year secular stretch. Before March's 2020 stock panic, the worst GSR witnessed in that past half-century was 100, and that was back in February 1991. That only lasted 2 trading days before silver mean reverted back to higher relative to gold. Our monthly gold to silver data runs much farther back in 1915 when it hit 77 to 1915 when it hit 97 to 1, 1940 and 41. And that was from FDR in the 30s. He changed the gold to silver ratio from 16 to 1 to 75 to 1. So, in the 105 years leading into March 2020, the GSR had briefly challenged 100 precisely twice, and I've seen multi-century silver and gold charts cobbled together despite data becoming increasingly sparse the farther back in time period. They implied that this crazy 124 to 1 level seen in mid-March was an apocalyptic all-time record low in silver relative to gold. We just witnessed something so extreme it never happened before. Speculators' most extreme silver futures long dump ever fueled silver's near crash, which obliterated this white metal to its most extreme lowest level ever compared to prevailing gold prices. Silver had never been cheaper relative to gold. The wildly unprecedented anomaly is incredibly bullish for silver. All past low silver prices, GSR extremes, have been followed by massive mean reversion higher in subsequent years, meaning that any time it does this, it shows that silver is going to catch back up, outperform gold, and the mean reversion happens. So, the last modern example came from the previous stock panic in October 2008. These ultra-rare selling events spawned such overwhelming fear that they suck in everything, including gold and silver. In the same single month span, where the flagship of the U.S. S&P 500 stock index plummeted 30%, silver collapsed 32%. That catapulted the GSR into 84 to 1 that month, which was a 13.6-year GSR high, or silver to gold low. Financial markets arbor extremes in long relationships, and not only they never last long, but prices almost immediately start mean reverting back towards normal ratios after they are dragged way out of whack by anomalous shocks. Then there is nothing more extreme than ultra-rare stock panics. The epic fear necessary to fuel them is so far beyond normal that they only have been 3 in the last 113 years. So, the silver-gold ratio, and indeed many long-term price relationships, are like pendulums. Equilibrium is the long average, analogous is the pendulum hanging straight down at rest. The farther a pendulum is pulled to either side of the extreme, the faster, more forcefully it swings back to its arc's bottom it means. But its kinetic energy, like momentum in the markets, propels the pendulum to the opposing extreme. So, I just want to wrap this up here because there's a lot more. But if you want to keep reading on this, the link to this article will be in the description. But basically, what's happened in 2008 is happening right now, and that led to $50 silver, and that's the bottom line. He goes on to mention how the gold to silver ratio, or the GSR, is showing that this happens, and how it hit 125 to 1 shows that silver is going to be outperforming gold. But I've heard some people on the other side of the fence say the ratio could go even higher. So who knows? All we know is that we are definitely bullish on silver, and there's a lot of things pointing towards that. So anyways, I'm going to wrap this video up here. I hope you enjoyed it. If you did enjoy this video, make sure to smash the like button. Go check out the video I posted earlier today as well. Talking about silver's worst enemy. You definitely want to check that out. You don't want to miss that as well. So anyways, thanks for tuning in. This was Silver Slayer. I'll see you guys soon. Peace.